Yeah, well, I mean, let me start. I think once you bring assets on chain, there's all these different things you can do with them. In our case, we're focusing on DeFi applications. So I think, you know, by digitizing various types of capital assets, you can start using them as collateral, and which basically, if you think about what happened on the lending platforms over the last 5-6 years in DeFi, you know, whenever something was collateralized with Ethereum, for example, it's so volatile that you get these margin calls, if you will, that basically wipe out your positions on the lending platforms. If you start using RWAs instead, such as non-correlated stocks or bond ETFs as collateral, and then you borrow against that asset, it provides a much more stable basis for the borrowing use case, for example. The other one that I really like is portfolio construction, so that if you basically digitize a bunch of real-world assets being financial instruments such as stocks and bonds and real estate and gold, you can start creating portfolios in a 100% digital environment, which would not be possible to create otherwise, because you'd have to go to different compartmentalized structures to buy the assets and then put that into a management structure, and then that costs money, and then everything gets horribly expensive all of a sudden, and then we're back in TradFi asset management.
Right. Yeah, so I think you're right on. I mean, the management of assets is also a big thing. That's also where we got in some traction. Like, you want to digitalize the asset not only for monetization's sake, but also for management's sake. So let's say, I mean, in Europe, we're talking about the ESG and CSRD, and also financial compliance. So, but it's really hard to, for example, alternative assets, to have compliance with them and, you know, to track everything that's going on. So once you have a digital copy, or let's say a digital twin of the asset, it makes it a lot easier to aggregate that data into some, you know, compliance and you know, reporting on the data. When the best way of doing that, for instance, for ESG, is like, you know, digitalizing an asset, you know where everything is coming from. And that's also where DLTs or blockchains can come in, and, you know, the traceability and transparency of the data that's coming in as well. So not only for monetizing an asset, like you mentioned, but also for just monitoring or managing that asset. I've talked about before, like JP Morgan actually released a paper talking about a $400 billion annually cost saving when it comes to management of assets, which is really interesting.
So the benefit that I would say, so what is a real world asset exactly? So real world assets are like things in the tangible real world, right? So like we've got real estate, we've got stocks, we've got all that stuff there. Why would we want to bring them into the blockchain world? Why would we want to turn those essentially into cryptocurrencies? It's because crypto is a more flexible asset type, is really what it is at the end of the day. You can really do so much with a physical piece of property, right? If you have a physical piece of property, how do you break that up into smaller pieces of property and sell that to fractionalize your real estate? It's not really something that we've been doing to create a, you know, very tangible use case for you guys. So tokenizing real estate actually allows us to sell like $50 worth of real estate to somebody. So you can own $50 worth of a house over in Chicago and make money off of the rent of that house, and make money as the equity goes up for that house. So it brings opportunity to individuals that has never been possible before, such as tokenizing with stocks as well, right? If you are living in a certain part of the world, you might not have access to be able to purchase the S&P 500, which creates a limitation of your ability to actually become a part of the financial world. It actually, there's a cutoff there. But if we have the ability to tokenize these stocks, then now this brings opportunity to different parts of the world that didn't previously have that opportunity before. And since we're creating less barriers to entry to purchasing these different stocks and real estate, that also improves the liquidity of these things, because now we're taking down barriers that allows liquidity to flow in from areas that were never possible before. Right. So real world assets being tokenized is not only improving liquidity from a standpoint of making it like currently markets that are fairly illiquid liquid, but it's also creating opportunity that allows more liquidity to flow into these markets at the same time.
Yeah, thank you. I mean, real world assets is not actually a new concept. It was just named differently. I've been through the ICO, STO, IDO booms, right? So during the STO booms, I saw a lot of securities trying to be brought onto the chain, like real estate, starting from real estate, fractionalizing luxury cars and so on. What do you think is different this time and compared to the 2018 STO boom?
What I think is different and what I talked about before was actually that you mentioned the $16 trillion and the promise of a market that size, but what we don't often talk about is that that market, and more than half of that market is actually assets that are owned by you and I, not traditional assets, land, but also assets such as data and volume as an asset. And I talked about, when you travel, you have two bags and you perhaps use one bag. That other bag is something that you're throwing away. So those types of assets that you're not using today, that's going to amount for the $16 trillion, not only traditional assets and commodities, but what's going on right now is that people are kind of looking into those types of new assets that haven't been identified. And because stocks and bonds already have an instrument per se, but those new assets do not have an instrument at all, which I think is really interesting. So I think that's what's going to drive us to do $16 trillion and more, perhaps. But we really need to work together in academia and institutionals to identify those assets and also, make them available in a tokenized manner, for sure.
Yes, I think, okay, so we launched our first security token issuance protocol at Bitcoin Miami in 2018, January. And I think coming out of the hype cycle in 2017, a lot of people thought two things really. Like, number one, people thought there would just be like magic internet money showing up. If you tokenize a fund or a company cap table, whatever, there would just be like magic money just like flowing in, and then all of a sudden, you would have raised your capital. Obviously, it didn't work that way, right? Especially not later into 2018 and 19. The second thing that we thought also was solved for, which wasn't, as it turns out, is secondary liquidity. So, there were platforms like Open Finance and T0 in the US, and we thought that, okay, those guys have, secondary liquidity lockdown. It's just that it didn't really work because, the SEC structure basically mandates a TradFi architecture onto blockchain, which makes the benefits of blockchain go away pretty quickly. So, I think it was just like early. It's kind of story of my life to some degree. It's like, doing things a little bit too early and then actually having to kind of work through the trenches to find an environment where it's working. So coming to why it's working, I think a lot of things, like I think regulatory is more clear, certainly in Europe, although not solved by any long stretch. But then it's also like validation by people like BlackRock and so on. It's like, it really matters. Like if somebody says that, happens to be the largest asset manager in the world, says that, well, this thing is actually legit and we're going to support it and we're going to build everything on I don't think they've actually said that, but like even on permissionless networks as well as permission networks, it's a huge deal. So I think all of those things together, and then I think in 2022 Q4, MakerDAO started using RWAs as collateral for DAI issuance instead of a bunch of other crypto as collateral. Also a huge shift because it turns out that non-correlated assets are much better collateral for issuing stable coins than using crypto that's highly correlated. So they just figured out that RWAs is actually a great piece of collateral for stablecoin issuance. So like all of these things together make this kind of a market that works now, whereas like 5-6 years ago, there was just no chance.
Sorry, what about the infrastructure, like on the user journey side?
Oh yeah, no, it's still shit. I'm sorry to say, but it's like, so that's why, yeah, so we built the latest incarnation of our protocols on Base, because we're hoping that that integration with Coinbase eventually will actually make it usable enough. But like, no, it's been horrific since like 2017. I mean, Ethereum was so shaky in 2017, it was barely usable. We're still using MetaMask. We're still using a bunch of wallets that are too complicated for most people. So huge point. And I think, there's a lot of work to be done in that space.
I'd say that the user experience is definitely getting better. So we are seeing progress, like with new wallets like Rabby Wallet is definitely a way better user experience than MetaMask. I'll never use MetaMask again. But yeah, I'd say that overall, just more adoption from big names like BlackRock is definitely, like, you get the largest asset manager to back something, and then immediately everybody's like, oh, wow, maybe this crypto thing is something I should look into. And so we have that happening. There's just more people in DeFi now is another thing. Like if you look at like the TVL metrics of DeFi, you could see that like we bottomed out, I think, what was it, like $60 billion in TVL? Yeah, something like that. Don't quote me on that. There's a number that is accurate and that might not be it. But we saw the TVL spike way up and then come down, but we had a floor of TVL. So we have all of this money that's been sitting in crypto, and people are starting to learn and know what to do with this money and move it into different places and get creative with things. So we just have more people that are in the DeFi world now, which naturally, if there's more people in the DeFi world, they're going to start to dive deeper into what they can do in DeFi, and real world assets is part of that. So education is continuing to improve, and that's really what I think is the big driver from like a macro perspective.
Yeah, but I also think, and really interesting that you bring BlackRock all the time as well, because it's really interesting that, well, I think what happened before was the verification of an asset, right? It's really important that you bought something, but you knew that it didn't have any intrinsic value, right? So it was more of a hunch, or, Elon Musk said something about it. But now we have real world assets are actually real world assets, it's something tangible. When it comes to gold or other types of assets, it's something that actually exists. So I think that's a really good driver of the market. And now we see institutions coming into this. I mean, JP Morgan talking about alternative asset tokenization. And yeah, I mean, I think one of the key points that is not solved yet is actually the verification of an asset. I don't know if you were at the main stage, but people are talking about, proof of ownership. But how can I prove an ownership of something if I don't have anything identifying that I own that thing? I think it goes against itself, right? So, and if you look up the definition of ownership, it's actually saying that the legal rights to own, distribute, or interchange something. I don't know if that's encoded into a blockchain. It cannot be, because you have to put your personal information on that. So those type of things needs to be solved in many ways, because I cannot prove I own anything without personal information, actually, not in the real world at least. So many things needs to be solved until we get to the mainstream and usability of real world assets.
Yeah, thank you. So what are you most excited about in the real world asset tokenization space next 1 to 5 years? Do you think we will reach these trillions?
Well, I think we will, but not in 5 years. But I think, like I said, these new types of assets that we are overseeing all the time, and that's really interesting to see that new types of assets coming up. And like I said before, those are going to amount for a larger part of those $16 trillion. I mean, like I mentioned, weight as an asset, data, you own data. When you drive around with your car, you sample a lot of data of road and sign quality and all of that. That data can be sold. I mean, it's a lot of assets out there that haven't been identified that you and I own actually today, but we don't use. So, and co-use of things as well. I know Air Baltic was talking about, like, if I buy a plane ticket, why can I not sell it to another person if I don't want to travel anymore? Co-use and reuse of stuff, those type of assets, I'm really looking forward to, like royalty systems and, being able to sell my right of something to other persons in an instant way. I think that's going to be really interesting.
Yeah, I think for me, it is that Internet of Value aspect, right? Like if we can get, people to just adopt the Internet of Value and start using it just as a second nature thing in the same way that people are using the internet, I think that's kind of what it's all about. And then it's a mix of obviously crypto, RWAs, and a bunch of stables and other assets. And, so it hopefully goes away at some point, like the whole technology layer. I can't remember who was saying, like, nobody cares about how email works. It just works, right? And it's like it's the same thing here. If I transfer value to you and it's instant and it's like, and we can combine things and do it very easily and quickly, that's the main benefit. And then, from that, we can build all these different products. But like, that's what I see in the next 1 to 5 years. And we're seeing like the digital generation is really kind of not accepting a lot of the limitations of TradFi. Like there's a lot of people like, what do you mean I have to wait for 2 days until I get my money when I sold my? What do you mean? Like, why is that? Doesn't make sense. There's a natural reaction against things that don't make sense for a digitally native generation. And I think that's where I see the big wave coming. It's like it's really from that digitally native perspective that drives the adoption. And then just like, well, that product sucks, I'm not going to use it. So I'm going to go over here because this is kind of more in tune with how I think about things.
I'm also thinking that there could be some liquidity that flows into the RWA space through the fractionalization of real estate, because I'm thinking that could be like a Trojan horse maybe. And the reason I say that is because we're like running into the problem where there's all these millennials and Gen Zers and like all these people that are like, oh man, inflation, I'll never be able to buy real estate at this point in time. So now you can, right? It doesn't matter if you like aren't making enough money to purchase a house outright, but we're entering into a world where you can purchase a fraction of a home. And then you can still try to fight against inflation with, you know, even if you don't have enough money for a full house, right? If you, because where are you gonna go if you're somebody like that wants to invest your money, but you don't have enough money to put into real estate, which is the quote unquote most stable, right? Or you could go put it into stocks, but like, what are you gonna do with that? So it's like, where do you actually put your money if you're in a position where you have like, you know, 30 grand or something like that you have saved up and you're trying to figure out what do I do to fight inflation? Well, fractionalized real estate could be a solution for them if it becomes more mainstream. So when people start to see that crypto is a technology that allows you to buy a fraction of a home, that could go viral very quickly. That is something that could be caught on by the generations that have that deep-rooted pain of like, oh, I can't buy a house, I don't make enough money, and inflation, blah, 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 blah. Well, you could buy a brick. You know? So that's something I could see that could go viral, like, as far as like
And it's easy to understand.
yeah, it's easy to understand is the whole thing. So I see that as an entryway for real world assets to really catch on, which I think could happen in, you know, a year to 5 years.
Yeah. May I add something to that? So I was going back to what you said as well, like nobody cares how it works. Well, I think actually people don't care how it works until it doesn't work. So like email, of course I don't care how I send an email, but as soon as it doesn't work, I want to contact, you know, somebody, why isn't this working or like that. So I think it's a two-way street as well. But like you said, I mean, I think real world assets are really interesting and real estate, but also like democratizing investment into like communities. So if I want to invest into something locally and I want to drive the investment in my area, that's going to be very positive and incentive for people as well. Like we have a project, for instance, in Chile where we have salmon farms. And what we do there is like fractionalized investment into these salmon farms that usually cost $25 million. So your regular person cannot invest into that. So what we do there is like, you know, go to the communities and like, you want to own a part of this salmon farm. So you get the community surrounding that asset to actually invest in their own land and so on and so forth. So I think that's very important as well. And I think that's going to drive the market for sure.
Another thing to kind of think about is what happens when one of these big companies like Apple embraces the idea of tokenizing their stock and says, let's actually add another utility on top of our stock that says, hey, if you hold Apple stock, you also get this type of benefit within our ecosystem, right? You get a discount on all Apple They would never do that, but they don't even give you the damn charging block anymore. They're not giving you anything. But yeah, but imagine that as a potential possibility that could come into this space. And then they say, actually, and if you stake your Apple stock, then that also unlocks X, Y, Z.
But that happens through guerrilla activity. So that's, you know, that's a good example. That's exactly what we do. Tokenize Apple stock. You know, basically we drop some coin on people that buy Apple stock on chain because we want to incentivize that behavior. But then once they stake that Apple stock, and then you start creating other incentives to actually kind of become a long-term holder as well. Now connecting that back to Apple, that's a really long journey because it's Apple. But then there's like other companies that are closer to their, I shouldn't say consumer brand, but like really closer to their consumer, maybe care more or have an easier way to provide benefits. and then you can create that loop easier or even more independently from the company itself. I think that's a huge thing. But even on like financial services, I'm still kind of a lot about like financial inclusion and just the whole like disintermediation thing and like the minimum ticket, like the salmon farming 25 million entry ticket. Well, you know, if you want to talk to a private bank, you need to show up with 10 million bucks, otherwise they won't talk to you. You know, it's like, no, like actually let's create like these mini family offices that consist of 100,000 SEK or 10,000 euros, and then start creating the exact same strategies as, you know, high net worths have access to, and family offices and institutions, because we can, because the transaction cost is now so low and the assets are available in a digital fashion, which basically means that you can buy any fraction of those assets and create a portfolio or strategies. I think that's a really big deal, and it's going to take a little bit of time, but it's like that whole inclusion aspect, and like you mentioned about like geographies actually being outside of even traditional brokerage access into, you know, the S&P or what have you. That's a big deal as well. And so, yeah, I think there's a lot of elements of democratization around, you know, what we're doing. But like, yeah, it has to be easy, it has to be available, and it has to also has to make sense, right? Like, so we're getting a lot of the questions like, why would I buy Apple on chain? Well, if you do it, you will actually see the next possible step once you've done it. It's not an intellectual exercise necessarily, it's actually by doing that you see the next adjacent possible step. And that's where creativity kicks in, and it's like, oh, wait, I can use it as collateral to borrow, to buy this car over here. I can do some other stuff over here. I can do some, you know, different things with it. So now all of a sudden, like, creativity kicks in, and that's when it gets really cool. That's what the internet is all about.
Yeah, and I actually have a question for you guys, because you guys have a deeper technical level of knowledge around this stuff than I do, from what I think so. I think so, at least. I'm more on the macro side of things. But one thing that we teach in our program is the difference between stocks and tokens, right? And we teach that stocks are stagnant. Stagnant stocks, then the crypto is more flowy, more creative crypto, right? Creates a new level of creative finance. And one of the things that we say is that stocks have like 1 point of demand, speculative demand, over what the value of the equity will be over time. Whereas crypto actually has 2 points of demand. It has the speculative demand, and then it also has the utility demand, because you need the token to vote on governance proposals or, you know, insert whatever solution here that crypto actually brings into the ecosystem of the project itself, right? So do you believe that we will potentially see a trend one day where some of these companies actually decide, well, if we tokenize it, we can now add a value of the stock itself into the ecosystem of our brand, and that will create a second point of demand, so that there will be 2 points of demand for our stock instead of just one, which could then increase the actual, you know, the valuation of the stock price.
Yeah, I mean, for sure. And connecting it back to the liquidity that we're talking about in the panel is, like JP Morgan did the study of alternative assets and access to alternative assets. And I found out that the market, the general market, is owned 50% by institutionals and 50% by private ownership. However, alternative asset market is actually 95% institutional and 5% private market. And the reason for that is management, of course. It's really hard to manage assets, as you mentioned, like you mentioned as well. But if you tokenize them, it becomes a lot easier to offer them to private individuals and so on and so forth, and it brings liquidity to the market as well. So in that type of way, for sure, you can have like a alternative asset for a company, and you tokenize the alternative asset per se, and then, yeah, I think it will drive a lot of other incentives surrounding that asset for sure.
Yeah, and I think, yes, so the share itself could take on a new meaning and have additional value. I mean, today it already has like the monetary value, like you said, and then it also has a governance value, right? So you can basically be part of a voting process if you're a shareholder, so that there are additional values to being a shareholder. But then with the tokens, it just becomes so much more kind of creative in terms of what you can do with it. And then you don't have to link it one-to-one to cap table either. You can do profit participation programs and other things. And then you, especially if I was running like a consumer brand company, I would definitely try to incentivize behavior, right? Just kind of drive people towards certain behaviors that will then, you know, make it more interesting to continue to become a customer, you know, with my company, and just kind of think about that in both kind of a loyalty point of view and just providing more and more value to the customers. I think that's like, it's a natural progression. And that's been by and large prohibited by number one, regulation, because like, oh, now we updated the shareholder registry. It's because we have a new shareholder. That's a, you know, that's like one complexity. But the other thing is just like transaction cost as well. Like if you can move value at a fractional level at basically no cost and it's instant, it just opens up a lot of other things you can do that you can't do today. So.
But also really interesting what you mentioned as well, that is, let's say, if I own a company, I'm a startup, and I don't want to liquidate myself. I don't want to give equity to somebody. I can actually just sell participation rights to my company. So let's say I want to invest in your startup, but you don't want to, you cap table, you want to change that at all. You just want to sell the future dividends of your company. And you can do that by tokenization instead of selling equity into your company, which is a really big step. So perhaps I don't even want to vote in your company. I don't want the ownership. I just want to take part of the dividends and the winnings of your company. So that's, or even a project within your company as well, or even sectors of your company. So that thing can be done with tokenization as well. So you don't necessarily have to tokenize the stock or the ownership of a company itself, but also participation rights or dividends rights and so on and so forth.
Thank you. You made it extremely easy for me. I love how organic it was. Do we have any questions from the audience? Go ahead.
Yeah, you're of course talking about all the benefits of this. Can you see any implications or any kind of any negative effects from tokenization?
Yeah, for sure. I mean, Moody's actually did a report of this last week or 2 weeks ago, and they talked about the tokenization of assets, and it definitely will bring liquidity to alternative assets. That's non-negotiable. However, asset managers don't want that at all. They want the transparency of it all. So they have a secret sauce, they call it. So they have a secret sauce of trading the assets and so on and so forth. So they are not allowing the alternative assets to be tokenized because of the transparency that tokenization brings. So it's kind of a battle. So Moody thinks, and it's like JP Morgan as well, knows that liquidity will go up. However, asset managers do not want the transparency because they have this secret sauce that they call. So that's one challenge there for sure.
Other thing that I can think of is if you have like sovereign ownership of a real world asset, that now means that you have sovereign responsibility. So if you're holding the tokenized stock or whatever within your own wallet, well, now that's your responsibility to do whatever you want with that. So if you connect to an improper platform with your wallet and sign a malicious smart contract, well, we do add other risks now when we move into a tokenized world that weren't there before. So that's a very important implication to where education is really, you know, what's necessary there to combat against that. And, you know, other tools that are being built like Wallet Guard and whatnot that allow people to navigate the space safely.
You're also exposed, right? I mean,
yeah.
In Sweden, you guys know, we see people that actually get robbed in their home of their crypto assets because they went to meetup.
Yes. Yeah, exactly. Well, yeah, and it's not only the physical aspect of that in their home, but it's also obviously the online hacks and all the frauds that's happening. Like if you were in the NFT market for the last 3-4 years, you would know that, like, I don't know, I bought some stupid shit on Solana, and then it's just like somebody sent me a link, and then all of a sudden what was it, like the soccer game with the apes that were playing soccer, my player was gone, right? So it's like, okay, that's a learning. And then anyways, it's like these things happen, right? And it's just, you know, it's definitely a negative. It's actually like, and I'm like, I have a decent radar for scams because I've been in the space. I bought my first stuff in 2016 or whatever, but like still it happens, right? And unless you're on top of your game, you are going to make a mistake, and then assets are gone. And they're like, especially if it's like, okay, so RWAs might be possibly recoverable in some situations, but like native bearer instruments, they're gone.
It's a much more hard-earned lesson when it's your house.
Yeah.
Yeah, but the house,
Yeah.
yes. So, you know, to your point, like actually changing the title for your house, that's a much more protected process in the physical world than it is in a digital world. So, you know, if somebody hacks and then all of a sudden owns my house, that's a problem,
Yeah.
right? So.
Well, it's a problem, and it's interesting that you bring it up. It's a problem on how tokenization is done today. with the anonymity, right? But if you introduce, let's say, a digital identity to it all, then you take the same procedures as is done in the manual world and you digitalized it with digital identities, contracts, etc., then it's no longer a problem, because if I get hacked, you still can see that I am actually the owner because I have an identity, and so on and so forth. So that's a way to solving the problem.
And that's what we have to consider when we're looking at all this is all new technology. So like while there are these risks that are inherent right now with the newer technology, and these risks will always be there, but we will continue to see new technologies come out that continue to help us mitigate and mitigate and mitigate and mitigate and mitigate that risk, so that it's a safer environment for everybody, even the newcomers that are coming in. So we just have to be patient, you know, the solutions are coming, and maybe you'll invent it.
All right, we have to. I think we have to bring the further questions behind the door. There are many people who want to ask questions. I think we're way over time already.
Rabby, Rabby.
What's your quick one?
I was wondering, how does asset tokenization deal with governance? Because one thing is I owe a piece of it, but if we're too many, who decides what to do with that asset?
It's a voting process there as well. It's no different. So we've done a bunch of governance votes based on token holding. You put in different levels that would need to participate for the vote to be valid. You basically derive a bunch of policies and procedures around how that's going to work in terms of participation and what those voting rights are. But then it's just a blockchain-based vote.
All right, thank you very much. It was amazing.
Thank you.